Welcome back to our second presentation on stocks. Exciting stocks, sexy stocks, risky stocks. And today we're going to take a look at the stock markets. The stock markets. We call it the stock market, but it's actually several markets. And so we'll see that the stock markets are changing at breakneck speed because of technology and the sheer number of shares that are traded every single day. So let's get started on slide 13. First, we must break the market into two: the primary stock market and the secondary stock market. The primary stock market is the market in which new issues of securities are sold to the public. Now, you've heard probably IPO, initial public offering. This is the first public sale of a company's stock. And it goes by various names: taking the company public, going public. Most retail investors do not participate in the primary market, and it is my recommendation, my opinion, that we really shouldn't. Yeah, maybe every once in a while, but folks, it's first of all, you usually don't get a very good price. And in general, the prices are not very good. Usually the price is overinflated because, hey, it's a new and exciting company, and don't you want to get on in the ground floor? Well, that happened 7 years ago. Yeah, hang on a minute. The secondary market is the market in which securities are traded after they have been issued to the public. The vast majority of transactions take place in the secondary market. And when people say the stock market, they're normally talking about the secondary market. But remember, it's more than just one market. But that's where we go to transact. When we're looking for a company that's been around for decades, we go to the secondary market. So let's concentrate a little bit on the primary market, even though we've said that, we're really not that interested in it normally. Why go public? Why should you take your private business public? Well, there are various reasons. You need capital. That's why it's sometimes called the capital markets. To raise money, to start or expand a business, to help pay for the ongoing business expenses. This is the lifeblood of many of our biotech companies here in San Diego. They're not making any money. They're burning through their cash. That's the term you'll hear, the burn rate. And, it costs $500 million, $800 million to get that drug to market. And where are they going to get the cash? Well, very few people are going to lend them the money. So they go to the capital markets, they go to the stock market and say, hey, we're this brand new company and we're going to change the world and you're going to get filthy rich in the process. And once a company becomes profitable and is a bona fide going concern, it's a way to gain prestige and respect within the investment and industrial communities. There's a story of Google when they were starting out in the early 2000s and making money hand over fist and thinking, well, I don't know if we really want to go public. Well, the big boys and girls on Wall Street came a-calling and said, if you go public, you're going to become instant multi-millionaires. So it's a reward for those who have started the business. And that's why we have some of the best companies in the world and the best entrepreneurs in the world, because the rewards can be enormous. But are you ready to trade your life for 6, 7 years of 12-hour, 14-hour days in the hopes that you take your public company, right? Because for every one Google, there are quite a number of Yahoos, which you still have heard of, but you probably haven't heard of Lycos or Alta Vista or Go or Ask Jeeves. Yeah, they didn't make the big time, even though they were all competitors at one time of Google. And simply, once a business becomes sufficiently large, it becomes very difficult for the owners to divvy up the spoils without going public. I mean, think about it. If you were one of the people who started GE or Coca-Cola or Walmart, how would you sell your share of the business? Right. And we talked about, I'm not sure if we talked about it in here, the issue of when large private companies ownerships change, the family can sometimes be hit with some nasty infights, and this happens in public companies too. But it can be really, really ugly when all the company is controlled by just a few people. One of the very good examples is if you're so inclined is In-N-Out Burger, the very famous and of all the people who are companies that are selling you stuff that destroys your arteries, they're probably one of the better ones, right? So check out the history of In-N-Out Burger, because when the couple that started it passed away, there was a fight in the family because they were a private enterprise. We ask, what are some of the largest private companies? Do you know? Some of them you haven't heard of, such as HEB, which is a big grocery firm and grocery store chain in the South and East. You ever have a M&M or a Snickers bar? Right, Mars. And then there's another very famous, very large food company called Cargill, which is private. But once companies get this big, they usually go public. Because the rewards can be enormous. I mean, the very famous CEO of Facebook, when they went public, his tax bill from the state of California alone was $1 billion. The tax bill. Right. Slide 15. Continuing, why go public? The corporation now doesn't have to repay the money. It's not like a loan. You've sold a piece of your, or usually a very large piece of your company. You're under no obligation, you, the company, to repurchase the shares of the stock. Whichever shareholders bought the shares may or may not be able to find someone who will purchase the shares from them. It depends on if the company succeeds or not. Of course, if the company succeeds, yes, of course they will be able to sell their shares. But now, once you've gone public, the corporation is no longer a private concern. It is now a public entity. And as such, it has many rights and responsibilities that private companies just don't need to worry about. I mean, you go to Mars or In-N-Out Burger and say, hey, would you tell us how much money you made last quarter? And they'll say, excuse us, who are you? Are you representing the IRS? We don't have to tell you that. But if you go to McDonald's, which is a public company which is selling stuff that destroys your arteries, yes, in fact, they'll say, go to our website, look under investor relations, and you can download the 10Ks, the annual reports, and the 10Qs, the quarterly reports. And I love to have fun with the students in the face-to-face class. I say, now, what's the annual report? And they say 10K. I say, what was that? 10K. What's the quarterly report? And they say 10Q. And I said, what was that? 10Q. What? 10Q. And then I look at them and I say, you're welcome. You see what you're missing if you're not going to the face-to-face class. Anyway, they must have at least one public meeting annually now. So every corporation has to have a public meeting, and there's certain legal things that have to be done. The interesting part of a local company here, Sempra Energy, San Diego Gas and Electric, there was a time that they made some pretty boneheaded maneuvers, and during their annual meeting here in San Diego, shareholders would come and let them know they were unhappy with their their decisions. And so Semper Energy said, "Oh, okay, we'll fix your little red wagon." They decided to have their annual meeting in London, England, one of the most expensive cities in the world. And they, you want to come yell at us? Go, you come yell at us in London, England. Yeah, right. They said it was because they wanted the board of directors to get to know Europe. Right. Let's read the bottom here of slide 15. IPOs do not usually live up to their expectations. The typical IPO loses 50% of its value within 1 year. When you take the Series 7 stockbroker exam, you will be expected to know all about the IPO process. But again, as I've said, it's usually not for us. It's just not something we want to get involved with. Benjamin Graham was not a big fan of initial public offerings. In fact, he said IPO stood for "it's probably overpriced," or "imaginary profits only," or "insider's profit opportunity." And dear students, I got to tell you that sometimes that's what's going on. They're selling pieces of the bright blue sky. Sometimes it works out, like Google and Facebook. Sometimes it doesn't. Most times it doesn't work out. In fact, Facebook lost 50% of its value within a few months, right? But then it came roaring back. So sometimes it works, sometimes it doesn't. Now, let's spend the rest of the hour or so discussing secondary markets. This is the market in which securities are sold after they've been issued. When people talk about the stock market, they are almost always referring to the secondary market. The secondary market is for existing issues for stocks and provides liquidity, which is a fancy way of saying you can easily transfer ownership of securities. You don't have to hang up a sign out front with a garage sale. "I'm selling my stock this weekend." And a very efficient mechanism for pricing and valuing the securities. So you go to your bank and you say, "I have some collateral for a loan. I have 100 shares of Exxon." And they say, "Okay, cool. What's it worth?" Well, you go to your cell phone or your laptop or call your broker, go log into your broker's account, and they say, "Oh, it's selling for X amount of dollars. So that 100 shares of Exxon is worth that much." And it's, assuming it's a going concern, a bona fide company, not one of these sham penny stocks. That is, of course, it changes every day, but that's a realistic value that you can put on the shares that you own. Now, this material on slide 17 is actually anachronistic. Isn't that a fancy word? It's a fancy word for outdated, obsolete. It's totally outdated, this comparison. Because there used to be two different types of stock markets. There were the organized securities exchanges, centralized locations in which transactions are made in outstanding securities. It's a double auction, which we're not used to. We're not used to a double auction. We're used to a single auction where there's one seller calling out prices and then multiple buyers bidding on the price, and the price goes up as the buyers keep bidding. But no, this is a double auction where there are multiple buyers, but there are also multiple sellers, all screaming and hollering and trying to make transactions. Oh, folks, it's gone. It's not there anymore. It's all electronic because of the sheer volume of shares that need to be sold and changed hands, sold and bought every day. The other type of outdated system is called the over-the-counter market, OTC. Now, this started out as a widely scattered telecommunication network through which transactions were made in certain securities, but mostly smaller initial public offerings and a whole lot of sham companies. It then turned into it became a quote-based system where there would be a bid and an ask price. I'm getting ahead of myself. That's the next presentation. But really, what this was, folks, when they say widely scattered telecommunication network, they meant widely scattered. There'd be these sham companies that you could buy, and some of them were real companies. I shouldn't say they were all shams, but most of them were. And some guy in Minneapolis had shares of this that he would sell, and then some other guy in Denver has a client who wants to buy them. So the guy in Denver would call the guy in Minneapolis and say, "You got 100 shares of Flim Flam Incorporated, or 1,000 shares or whatever." "Oh yeah, how much you want for him?" $25. And he'd slam down the phone and say, "No, there's no way I'm paying that." Slam down the phone, and then 5 minutes later call him back. "I'll give you $22. And then the other guy would slam down the phone. They took lessons in how to be rude to one another, and it was just, it's part of the culture. It's all computerized now. There's nobody picking up the phone and yelling at one another. So due to technology advancements, mergers, acquisitions, the traditional differences between the two have been erased. It's all electronic now, and the changes are just getting started. Slide number 18. The Organized Securities and Exchanges. Remember, it's called the SEC for a reason, Securities and Exchange Commission. Right. Historically, all trading was conducted on the exchange floor. On the exchange floor, and they still show it on and it's still open in New York Stock Exchange, but it's just see a few people just standing around. They're not yelling and screaming and throwing paper at one another. And all you got to do is type in video of the old school exchange floor, and you'll see old videos. But now I think they keep it open just for television, right? They get just something to show on television. But the people are just standing around. Every once in a while, there's people trading. You'll see people yelling at one another. But all trading was done using a double auction. Instead of the one seller, multiple buyers that you see at an estate or at a farm auction, for example, there are multiple sellers, multiple buyers on the floor calling out prices and quantities. In the face-to-face class, we show a little video of, it's basically historical. It shows the worst day of the century, the worst day ever in the market, October 19th, 1987, Black Monday. But it also shows how the trading was actually done. But due to technology and the sheer massive volume of shares traded, things have changed. Almost all trading is now conducted electronically. Some large trades still involve human interaction, but they're far less than probably 0.01%. I don't know what the actual number is, but they're very little. In fact, they have this one guy he's very photogenic. He's got white hair and beard, and they always show him. I forget his name, but he defended the system. He said, we're still needed. We humans are still wrong. Everybody's sitting in front of a computer now, doing it electronically. And the granddaddy of them all was the New York Stock Exchange, and still is the largest exchange. It's sometimes called the NYSE, the Big Board. It's all electronic. But traditionally, this was responsible for over 90% of the volume of transactions on exchanges. Around 2,800 companies, about I'm supposed to update that to 2023. About $25 trillion of market capitalization, and about 1.5 billion shares traded daily. Billion shares, right. Can you imagine trying to trade 1 billion shares by hand? Even though they had, thousands of people or hundreds of people on the floor. It was established as a members-only entity in 1792 when Wall Street really was next to a wall in Manhattan. The companies listed on the New York Stock Exchange must meet stringent requirements. They were the largest and most prestigious companies for, a couple hundred years. But notice we put the word traditionally there. Now they're not necessarily the largest companies anymore and not necessarily have the most stringent requirements. And if your company hits on hard times, you might have heard of Kodak. Some of you have never even seen film. But before the 1990s, well, actually, it was the 2000s when the digital cameras really took off. No matter where you went, grocery stores, convenience store, drugstore, there were little yellow boxes, Kodak film. They're gone. So if the company hits on hard times, the New York Stock Exchange says, we don't want you anymore. You'll have to leave the New York Stock Exchange and go to one of the OTC Bulletin Board or Pink Sheets, the wrong side of the tracks, the red light district, the bad side of town. We'll talk about them in a little bit. But it's all changed, right? In 2005, the New York Stock Exchange purchased the Archipelago Electronic Exchange and the Pacific Regional Exchanges. We'll see those in several slides later. They became a publicly traded corporation used to be a partnership in March of 2006. They merged with an electronic exchange in Europe called the Euronext. They phased out the face-to-face double auction trading in favor of exclusively trading electronically. And then in 2011, Germany's stock market tried to purchase the New York Stock Exchange, but was blocked by the Europeans, not the United States regulators. And then on November 13th, 2013, the New York Stock Exchange was acquired for $11 billion by a 13-year-old derivatives trading firm from Atlanta Intercontinental Exchange that didn't exist until the 21st century. In 1992, on their 200th birthday, if you had told the folks at the New York Stock Exchange that the next 20 years, 30 years would see far more changes than in their first 200 years, they would have thought you were quite insane, but you would have been correct. So the New York Stock Exchange just ain't what it used to be. It's still the world's largest exchange, dear students, but they're no longer the 800-pound kid on the block and there's nobody around to take them on. Stick with us. Now, how did this used to work? Well, there were floor brokers, some working for certain houses like Merrill Lynch and Merrill Stench and Morgan Stanley. Anyway, the big brokerage firms. And then there were independent brokers that ran around and did work for people who needed help. They called them the $2 brokers, but they're all gone, right? They're gone from the floor. They're still working, but they're no longer doing face-to-face interaction. The floor brokers were very worried that the New York Stock Exchange's aggressive moves to all electronic trading meant the end of their way of life. It wasn't really the end. It was just a big change from face-to-face interaction to sitting in front of a computer screen all day. Does this sound familiar? What are we doing right now? Here I am sitting in front of a computer screen giving the presentation, and there you are at some other time watching it. We still have face-to-face classes. In fact, I hope you join us sometime this semester if you can. And if you can't, that's fine. That's the way we set it up. We're live streaming and recording the class sessions, and we pre-record the lectures because we want you to be awesome. We want to help you with time management. But I sure do miss the face-to-face interaction. What can I say? Now, the specialists. Now, here's where we're going to discuss some of the inner workings. They're still there, but it's all electronic now. It's all computerized. There were people on the floor called the specialists whose job was to make transactions in one or more stocks. The job of the specialist was to manage the auction process. They buy and sell stocks, or they still do, but it's all electronic. It's all done by computers. They buy and sell the stocks from their own inventory to provide a continuous, fair, and orderly market. In other words, folks, what if all the buyers disappeared? What's going to happen? Price is just going to start falling. The job of the specialist was to stand in front of those sellers and start buying. And the exact same thing happens on the other side. If all the sellers disappear and everybody wants to buy, the price is just going to start skyrocketing. So the job of the specialist was to jump in and start selling. The role has essentially been squeezed out by technology, the tremendous volume of trading. They're only involved in a tiny amount of trading each day, hand to hand, not computerized. And they're no longer called specialists. They're called designated market makers and supplementary liquidity providers. In other words, they're computers. From time to time, the specialists were either praised or maligned. Suffice to say that the specialists were trying to make a profit just like everyone else. While their goal may seem altruistic, they made sure that when the market received benefits from their efforts, so did they. Now think about it, folks. This is a position that could have tremendous sway and unethical and obviously illegal hanky-panky going on. And there, from time to time, there was somebody who was caught doing things they weren't supposed to do. But for decades, it worked pretty darn well, pretty amazing. Considering the potential for trucos, travesuras, for hanky-panky. So I wonder how, if they had started in this day and age, where elected representatives do their best to steal money and lie and cheat and get away with it. So I wonder. But now it's computerized. Okay, so that was the New York Stock Exchange. Who was their little kid brother? Who was the poor relation? The American Exchange, the Amex, the Curb. Curb? Where did that name come from? Well, guess what? They started on the curb outside the New York Stock Exchange. They'd look in the window, see what was going on, and they'd trade out on the street, out on the curb. And luckily, there's a photo if you want to click on that. Luckily, they got their own building down the street because it's cold in the wintertime in New York. They were always much smaller than the New York Stock Exchange. Only 3% of the volume of the exchanges. They saw the handwriting on the wall 30 years ago, and they started concentrating on securities other than stocks over 20, actually now 30 years ago. What? I think it was 1993, right? That's where the ETF started. Remember the exchange-traded funds? They started on the Amex. They started on the American Exchange. Now that you can find them on any exchange. They're on every exchange. And then what happened? Well, the NASDAQ said, hang on a minute, we'll get to the NASDAQ in a little bit. NASDAQ bought the American Exchange in 1998 and then kicked them to the curb, pun intended, sold them in 2004. The New York Stock Exchange said, well, okay, come on down the street, because they're right down the street from the New York Stock Exchange, and they bought them in 2008. They then changed their name to NYSE Market, MKT. I don't know what MKT was supposed to stand for. And now, mercifully, they've changed the name to New York Stock Exchange American. People call the American Exchange. Smaller companies, things that are not really stocks like ETFs, they've never really made the big time. So this is what we had. We had the New York Stock Exchange and the Amex, the huge 800-pound gorilla, and then the 8-pound weakling. And we also had, and still do have, regional exchanges. They were modeled after the New York Stock Exchange and the Amex. Chicago, Philadelphia, the Pacific Exchange, the Boston Exchange, the Denver and the Cincinnati exchanges. Again, all of them only accounted for at a maximum of 4% of volume. They were all centralized locations, except for the Pacific, which is in Los Angeles and San Francisco. Many of the securities listed on the regional exchanges are also available on the New York Stock Exchange or the NASDAQ. Traditionally, the regional exchanges were often places where undesirable or unethical issues were sold, especially the Denver exchanges. If someone said, I bought this stock on the Denver exchange, I don't really know what it is, you just shake your head and say, oh, good for you. Lately, they've tried to diversify and differentiate themselves from the New York Stock Exchange and the NASDAQ in order to survive. The Philadelphia Exchange started specializing in silicon chips and specializing in companies that made computer chips. Plus, they have not been immune to the rush to consolidate. The New York Stock Exchange bought the Pacific Exchange. The NASDAQ bought the Philadelphia Exchange. Hey, NASDAQ's technology, and so buy the Philly Exchange because they're specialists, whatever that means, in silicon producing companies and computer chip companies. And then there were exchanges for options and futures. Now, we've made mention of these things. Derivatives. The two major ones are the Chicago Board of Trade for futures and the Chicago Board Options Exchange for options. And this makes sense, folks, especially forget the options, but the futures, we're going to see that the futures deal with wheat and corn and pork bellies, which that's what they make bacon out of, and beef. And that's where most of the Midwest foodstuffs go through. They go through Chicago, so it made sense. And we'll discuss the options and the futures in detail later. But now, because of competition, they are available everywhere. Options and futures are also traded on the major and the regional exchanges, as well as the two major exchanges in Chicago. Okay, so those were the exchanges. Those are all centralized locations that are now all computerized. The widely scattered telecommunication networks that made up the OTC market, the over-the-counter market, were just that. As we said, some guy in Minneapolis, some guy in Denver calling each other, slamming down the phone and shouting at each other until they made a deal. They took lessons in how to be rude. But they have gone electronic now. Aha! There were three tiers to this. There was the NASDAQ, which no longer wants to be associated with the other two. There is the Bulletin Board and what used to be called the Pink Sheets. Pink Sheet? Yeah, it was they published a newspaper that was on pink paper, so they called them the Pink Sheets. But now they call them the OTC Bulletin Board and the OTC Markets Group. Now, folks, there are thousands of companies on these exchanges. Stay away. Every once in a while, there'll be a company that's actually trying to make money. It's hits the skids. They're in deep trouble. But most of these are sham corporations. There's somebody's garage in Idaho or Iowa or one of those places that starts with the letter I. In fact, I was amazed. I didn't want to watch it because it's pretty raw, but there's a movie called The Wolf of Wall Street with famous actors. And they showed a garage in Iowa as the sham corporation that the guy was selling. And so just stay away from these places, folks. They sell these penny stocks that are garbage, and we'll see some examples of penny stocks, but that's the red light district. It's the wrong side of town. It's the bad kind of town, the wrong side of the tracks. Now, what did they use, and what do they still use, is a quote-based system, and that's what's being used electronically. As opposed to the double auction, they would show you what they were willing to buy the shares and what they were willing to sell the shares at what price. So there were two prices, and we'll see how that works in more detail in our next presentation. So again, as we said, there are three tiers, but the NASDAQ no longer wants to be associated with these two, and with good reason. If I were running the NASDAQ, I would not want to have anything to do with these other two groups, even though it's all electronic now. And how does the OTC work? Well, dealers, sometimes called market makers, were traders who make markets by offering to buy and sell certain securities at stated prices. As opposed to brokers who are go-betweens, the dealers have an inventory of the stocks, and they will buy and sell from their inventory. In other words, they're like the specialist on the New York Stock Exchange. They offer buy and sell quotes from their own inventories of stocks, whereas brokers simply serve as a go-between. Brokers don't keep an inventory. So now, we're going to go over this in detail. We're going to show you how it works. There's an ask price, which I wish they would use the term retail price. I think that makes a whole lot more sense. And then there's a bid price, a wholesale price. So if you want to buy shares using this system, and now everybody uses it basically, you are going to see two prices, not just one price. You see one price when you look it up on the Infernal Net, but then you might go over and see that ask price and the bid price and think, what are those things? But we'll discuss those later. You're going to have to pay the retail price. But then when you go to sell your shares, you're going to get the bid price, the wholesale price. You see the difference? Because the dealers are not going to pay the ask price. They're going to pay the bid price. And I know it's hard to remember those two because they don't mean a whole lot. But remember that if you have to ask for it, it's more expensive. I think that helps. The retail price and the wholesale price. The spread is the difference, the bid-ask spread. And in the movie, the guy says, look at these spreads, not explaining to the audience that it means that there's a big difference between what they will sell you the shares for and what they will buy the shares back from you. The dealers, the market makers on the New York Stock Exchange, on the NASDAQ, perform roughly the same role as the specialist on the New York Stock Exchange. So, unlike brokers who charge a commission, dealers, market makers make money from the spread of the bid and ask prices. Now, some of you might be familiar with this when you go down to Tijuana, or if you're down in the South Bay, San Isidro or Otay Mesa, you will see the Casas de Cambio, the money exchange houses. And you'll see not one price, you'll see two prices. What they will give you if you give them $1 and they'll give you a certain number of pesos. But if you want to get dollars, you have to give them more pesos. And they make money on the difference. Now there's going to be a presentation, it's not there yet, but there's going to be a presentation that describes how that works. And in the face-to-face class, we'll show it, so it'll also be on one of the recorded presentations. The dealer's markup and the markdowns are not reported to the customers, whereas the broker's commissions are reported. So you see, you ever wonder how these brokers make money on $5 trade or now $0 a trade? How do they make money? Next presentation, we'll show you that you're getting charged, folks. Don't kid yourself. Oh, I don't pay any commission. Yeah, right. Yeah. They're making money off the spread, the difference between what they will sell the shares to you and then buy them back. Finally, we get to the NASDAQ. We've been using this term. We've been talking about it almost all semester. We've been throwing out the term. What is it? Well, it stood for the National Association of Securities Dealers Automated Quotation System. How's that for a mouthful? They don't want you to think of that. They don't want you to remember that. They just want to be known as the NASDAQ now. There used to be an organization called the National Association of Securities Dealers. This was the non-governmental organization that used to be responsible for the self-regulation of registered representatives, that's a stockbroker, and the brokerage firms. That's now done by the Financial Industry Regulatory Authority, FINRA. NASDAQ, National Association of Dealers, Securities Dealers, started this NASDAQ, National Association of Securities Dealers Automated Quotation System, back in 1971, when, networks were very, very, what's the word? Not obscure, but they're very primitive, very primitive. In other words, get away from the telephone. We want to do it all electronic. And sure enough, now it's, hey, everybody does it, right? They have about 3,300 stocks on the NASDAQ. And what they eventually did is they said, look, don't call us the National Association of Securities Dealers, call us the NASDAQ, and we don't want to do the self regulation of the industry anymore. We don't want to be involved with that. We're going to be a for-profit organization that makes money as an exchange, basically, as a stock market. The NASDAQ used to be the arena for small companies to get started. Once they became large enough, they would, of course, move to the New York Stock Exchange. However, since the 1980s, many prestigious companies decided to stay on the NASDAQ, thank you very much, rather than move to the New York Stock Exchange. You might have heard of some of them. Apple, Microsoft, yeah. Dell, Starbucks, Costco. You've heard of these companies. Amazon, Netflix, and there were two words at the 23rd floor of the New York Stock Exchange building on Wall Street, spoken in the boardroom on the 23rd floor. And the first one was, oh! You can guess what the second one was. And so now it's a two-horse race. Whereas before the 1990s, 2000s, the New York Stock Exchange was the it. They were the exchange, and everybody else was just chump change. No longer. Now the largest companies in the world are on the NASDAQ. The NASDAQ is now a three-tier system. There's the global select, the global market, and the capital markets. Now, most people don't even know this. They just know that it's on the NASDAQ. And maybe they don't even care. But the global select these are companies that would easily qualify for the New York Stock Exchange. The global market are larger companies, and then the capital market are these smaller companies. And in fact, they used to be called small cap market. In the 1990s, this was a sort of a dig at the New York Stock Exchange. They began positioning themselves in their advertising as the securities market of the future, as it became apparent that the traditional face-to-face double auction model was not adequate to keep up with the massive increase in trading. You see, who was the securities market of the past? The New York Stock Exchange. Well, folks, the New York Stock Exchange still is larger than the NASDAQ, but not a whole lot larger. 19 trillion versus what was the other one, like 20-some trillion. So it's a two-horse race, and we're going to see in some of the worksheets, actually one of the worksheets, or one of the two of the worksheets, where companies have flip-flopped. One started on the NASDAQ and then moved over to the New York Stock Exchange, and vice versa. Started on the New York Stock Exchange, move it over to the NASDAQ, because they're competing. They're competing. They're in business. They want to attract more of their customers. And in this case, the customers are corporations. So those were the major systems. Let's take a look at some alternative trading systems. The third market, the biggest player was the intermarket. That was the name of it, intermarket. See underneath the example. These were OTC transactions made in securities that were listed on the New York Stock Exchange, the Amex, or one of the other organized exchanges, but they were only for institutional investors who traded in large blocks of securities. Why? Because if you're a mutual fund or you're an insurance company or a pension plan, you're not going to buy 100 shares. You're going to buy 1,000 or 10,000 or 100,000 shares. So by working through a system where the buyers and sellers were trading large blocks of shares, you were able to reduce the transaction costs. You see, basically, you don't, if you're going to buy, 5,000 bricks, you don't go down to the local Lowe's or Home Depot, right? You go to a wholesale place that can sell you huge quantities of materials. And that's the same idea here. These were facilitated still by a dealer, but it was able to reduce the transaction cost by bundling the the transactions into very large quantities of stocks. Notice that intermarket was bought by the NASDAQ. Yeah, we're going to get bigger and bigger and bigger. And then there was the fourth market, where it was the same idea as the third market, large institutional buyers and sellers, but the idea was to get rid of the dealer and use an electronic system, kind of like eBay, if you ever used eBay. Electronic communications networks, they started to be called. Privately owned electronic trading networks that automatically would match buyers and sellers that customers placed electronically. Archipelago was one of the big ones that was then bought by the New York Stock Exchange, and BATS, Better Alternative Trading System, is now owned by the Chicago Board of Exchange. You see, with the advent of the internet, the technology became such that the third and the fourth markets could start to court retail customers, people who weren't buying 10,000 shares but are buying 50 shares or whatever. And the New York Stock Exchange, the NASDAQ, the CBOE all stood up and said, oh, we want to get a piece of this. BATS is really interesting, folks. Everything used to revolve around New York. Of course, now the New York Stock Exchange is owned by a company based in Atlanta. BATS started out, I don't know if they're still there, they started out in a strip mall in Kansas City next to a grocery store. Technology. So, you see how the changes, and it's not stopping, folks. They're still jockeying for position, trying to get ahead of one each other, because these are not non-profit organizations, folks. They're making money. Every share that changes hands, they're getting a little bitty piece of a penny. But there are billions of shares trading hands every day. And you're going to get this question from your brother-in-law, or maybe somebody who's not as angry. Just maybe sister or friend or coworker. But we're on slide 33, by the way. Isn't the stock market all just one big malignant casino? It's a legitimate question, folks. And the answer is yes and no. Huh? Well, yes. For those people who see the markets as a big crapshoot, as a gambling house, as a casino, the way they believe to riches is to buy and sell, buy and sell, buy and sell. We do not call these people investors. We call them speculators. We call them traders. It is very difficult. You're up against the best in the business, and most people don't last more than a few weeks, 3 weeks, a month, and they've lost their $5,000, and they say, I'm never going to do that again. The answer to the question is also no. Many others look at the capital markets as a way to participate in the growth and prosperity of the global economy. This is what we want you to be. We want you to be an investor with a long-term orientation. Investors are usually very well rewarded. And I firmly believe the next 20, 30 years will be very good for stocks. It will be very good for business, very good for the economy. Some stocks are very expensive right now, and so they might not have the same, well, I don't think they're going to have the same run-up they had over the last 10, 12 years. Doesn't mean I'm right. Doesn't mean I'm wrong. That's why they call it the future. But this gives us yet another opportunity to recall our wonderful definition from Mr. Benjamin Graham of what an investment is. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Right. So are you going to be a trader, a speculator, or are you going to be an investor? Slide 34. Oh yeah, Payano. What about Enron? Some of you have never even heard of Enron. It was 20 years ago. Aren't corporations all crooks? Well, fraud and accounting trickery and gimmicks have always been with us. They're always going to be with us. Why? Because that's where the money is. That was a saying attributed to the bank robber Willie Sutton. He didn't actually say it, but it's a great saying. Normally, but not always, these firms are regulated to the nether reaches of the OTC. What does that mean? They're on the bulletin board, the pink sheets, the wrong side of town. But for every one Enron, there are hundreds, no, actually thousands of companies that continue to do business with integrity and honesty. Well, usually. In 1973, it was Equity Funding, and a life insurance company that went bankrupt. Folks, life insurance companies do not go bankrupt. What was Equity Funding doing? They were literally going into a room and making up policies. They were just making up names and filling out policies and saying these people were paying them, which they weren't. They weren't real people. In 1986, it was Ivan Boesky and Michael Milken and Vagabond Inns, which you've probably seen one. They're based here in San Diego. They were using Vagabond Inns, the motel chain, as a front for hanky panky, for theft. In 2002, it was Enron, Global Crossing, Tyco, WorldCom. In 2008, it was Fannie Freddie, Lehman Brothers, Citi, WAMU, Wachovia, and AIG. And don't forget Bernie Madoff, the largest, most successful Ponzi scheme in history. It went on for 15 years. Look, folks, the first time you take an investor's money and put it in your own pocket, you know eventually you're going to get caught. It's only a matter of time. And the fact that usually they don't last more than a year or so. The fact that this guy did it for 15 years is just amazing. Well, he used to run the NASDAQ. Twice he went in front of the Congress to testify how we can make the securities markets more secure and less temptation to commit theft. How's that for irony? Well, right now we got the same thing going on. I haven't been following this guy because I don't believe in kleptocurrencies, but he had some kind of scam going on, and he's probably going to spend the rest of his years in his life. 10 or 20 years from now, during the next big bull market craze, someone else is going to take their place because that's where the money is. Slide 35. To recap, the securities markets exist to allow investors a safe, cost-effective method, efficient, to participate in the success of the global economy. And even with all the underhanded shenanigans, they have performed actually very well. And they're changing at breakneck speed, and the change is accelerating. Now, whether or not we ever have one or more global 24-hour trading markets remains to be seen. But it is exciting and for some scary to watch, especially for those of us who have a stake in the outcome. You heard about this about 5-6 years ago, actually starting about 15 years ago. We're going to have a 24-hour trading network, and you don't hear about it that much anymore, which I'm very happy. I mean, it's 2 a.m. in the morning. You don't need to sell your 100 shares or your 15 shares of McDonald's. You can wait until the morning, folks, okay? Okay, it's got to be sometime when the people sleep. But remember, it's a global economy, so while we're sleeping, there's people trading on the other side of the globe. Well, anyway, go back over, make sure you know the biggies, right? The New York Stock Exchange, the NASDAQ, the over-the-counter markets, just so you'll stay away from them. Dabble in a few of the more obscure places. Because when we come back, we're now going to take a look at transactions. How are the shares traded? What are the mechanisms? And how much does it cost? Cool? Are you getting an education? I sure hope so, dear students. Thank you so much for being in our class. We want you to be awesome. Remember, there's a future for you in the industry. The industry needs you. They need more women, more minorities, more bilingual, trilingual, and they simply love veterans. See you on our next presentation when we discuss stock transactions and transaction costs. And we're going to learn that no, you're not getting free trades. No, it's just not. It's too good to be true. Yeah.